Good afternoon, everyone. Capital deployment. So I'm going to share with you over just 5 slides how we are looking at improving capital deployment alongside customer service to drive improved returns and deliver a much more competitive Diageo. Every drop of liquid we distill, every barrel we choose to fill, every pallet that we make and move around the world has to work harder for returns on the capital, our capital, your capital invested in this business. It's an investment portfolio and needs to be managed accordingly. I'm going to unpack for you across how we are resizing and reshaping our operational footprint and the returns that will come with that. Our capital deployment, where is that CapEx going, and what returns are we expecting? Our working capital, I will talk about full working capital, so finished goods in our day's inventory, but I will also highlight in particular something you're all interested in, which is a large amount of capital that's already invested in our distilled spirits and maturing liquids. And then I'll finish with customer service and give you an update from Dave's comments at the half year, where we sit and what work we've still got to do. Okay? First up, as demand and the market has changed and our growth assumptions has changed, we have to take the difficult decisions around about our operational footprint. And those decisions are based on the right asset utilization, structurally getting the costs right for the future, improving the resilience of our business, and improving customer service. They are the principles that lie behind that decision. We've had to take some of those difficult decisions that put us into $300 million of cost, including some of the impairment charges that you heard Dave and Nick talk about earlier today. That's involved impairing 3 of 34 sites in Scotland around our Scotch distilling footprint, 1 of 3 tequila sites, and 2 of 5 North American distilling sites. Alongside that, we've been running over the last few years, you've heard about the supply agility program that became part of Accelerate. And as you look at the delivery in that, this is in our spirits packaging network in the center of the presentation. We've been, against those principles I outlined, optimizing that for the future. So quite significant changes in North America, moving from 7 to 3 sites, including the new site that was built in Alabama. Europe, the sale of the Santa Vittoria site, but consolidating into highly utilized, high-performing assets with a lot of supply chain agility in Scotland. And then in India, a pretty remarkable scale of transformation, which did include, in this occasion, some third-party partner sites, but moving from 100 to 35 sites. And that is all delivered and in place. Only 8 of those 35 are Diageo owned. The rest are our partners that we work with across India to deliver our service to customer. Having done all of that, that delivers the returns and the savings, where about $135 million is already in the recurring savings as we close F26. And as you'll hear from Nick later, as part of the overall savings and delivery, there's $150 million that will come through over the 3-year plan period. And there's more that actually comes through against that because we've been impacting our distilled and the working capital on our balance sheet that will flow off the balance sheet as the liquid hits the P&L in the future. Okay. Disciplined, dynamic, and returns-based capital deployment on CapEx. That's the approach that we continue to take and we are strengthening as part of the strategy and the operating framework. You've heard already from Dave and Nick around it being at $1.25 billion. Broadly, half of it will be supporting growth. Of the $3.75 billion that goes in over the next 3 years of invested capital, just under $1 billion of that is invested in Guinness, and the rest is supporting growth. Some highlights that I called out were particularly around about, you heard in the breakout with Mark Sandys, unless you were online, that we're investing very selectively in RTD. We have good capacity and strong networks and route to markets, but there are some selective investments, particularly in GB market in Europe, where we'll strengthen that. And in North America, you heard from John about the importance of that investment in small formats that's already underway, and that cash will go through this year as we bring that capability online. Also, as you'll hear, as I talk in a further slide around maturing inventory, as we've been looking at our inventories and the amount of liquid that we will choose to still distill, we're reducing our barrel versus the prior 3-year period. We're reducing it by more than 50% in the forward 3-year cycle. So a significant intervention that looks at what the right sizing is as we move through. And then very selective capabilities around about our cost reduction and the capabilities to make us a more competitive organization. They need to come through. They're actually increasing in the digital space as the SAP S/4HANA costs come down. We're making sure that we are selectively returns-based, driving the right prioritization of those investments in the business in line with the deliverable of the 3-year plan. Working capital efficiency. As it stands today, we have moved from 110 DIO. We've moved it to 90. We've got a little bit that sat in today that Nick explained earlier today, where we had the SAP S/4HANA inventory to manage through the period of downtime in production during July. And we also had some Middle East protection that was in. But the underlying is at 90 days. The move from 110 to 90 days essentially is moving us from just over 3 turns to 4 of our inventory in the year. So making that capital work much harder for us in terms of how we're delivering that. That is coming from the investments that we've been making in advanced supply and demand planning, the IBP process, so the integrated business planning process, and ensuring that we are using machine learning, artificial intelligence, having the right data feeds that are combining with market intelligence to make the choices and decisions for our business. And when we make choices to put in place that working capital, it has to make sure that it's delivering strongly. And when I come to the customer service slide, you'll see how that's not necessarily been the case because of the maturity of some of our processes and capabilities and competency in the organization and how we're fixing that. I will say that already the go-to-market organization has significantly shifted the culture in the company and the approach to moving things. We've still, as John has said and as Alvaro said, we've still got a long way to go. But already those signs are coming through strongly that people understand in the business that when we take decisions around shareholder capital and we invest it to get the returns, we have to make sure that that is done with very clear discipline building blocks that we have then belief will come through, and we don't generate, the slow and obsolete type goods that we're driving here, almost double-digit DIO. Right? That is an opportunity. We're confident in the work that we're doing around the portfolio segmentation, the rationalization and focus of that portfolio, and the systems and the people capabilities that will take that to 85 days. Each day is worth about $20 million. And we have an ambition to take that below 80. But we need to prove that we can do that, and we need to bring that through. So I look forward to talking to you in the future on how we move that through. But go-to-market is strengthening that point of accountability and making sure the decisions are much more integrated with the customer at the center of it. So when I started around about working capital, returns, customer service, they come together to make us have better returns and a more competitive business. Now, I said earlier, I commented around the mindset and how we think about this. This is already deployed shareholder capital, 8.5 billion of maturing stock. It's a sizable competitive advantage if it is deployed correctly. Now, it's already deployed. It doesn't mean that we can't make the returns even better than the choices we've already made. So one of the areas I wanted to highlight was something I am very proud of. It's already delivered results. It was recognized with the Gartner Power of the Profession across all industries and sectors this year in 2026, which was our Scotch intelligence platform that is very quickly now elevating and extending into being our spirits intelligence platform. What that has already done in F26 is give us $100 million in our P&L of further NSV. How has it done that? We've been able to take our allocated scotches, which tend to be some of our single malts and some of our deeper aged, so the higher gross profit dollar parts of our portfolio. And as that's allocated out at the start of a year, we need to make sure we're remaining dynamic in that year to the changing market conditions, the impact of our activations in the markets, and is it selling through, and stopping it being at risk of sitting in a warehouse after it's been bottled and tying up capital. So pre-bottling, the allocation is done dynamically with decision engines and artificial intelligence within that platform. It looks at what's happening in rate of sale in every market in the world, looks at pricing, and it automatically recommends decisions through to then change the allocations. And it's an online trading marketplace between the markets where they can move inventory away because they can't sell it and someone else can take it. That's given us 100 million of additional sales in F26, and will continue to scale and give benefit. The second thing that the Scotch, or now the Spirits Intelligence platform, does is it looks at, and it's built with the relevant digital twin information, and it will get better and better and better. But we're now confident to see that as we take decisions on how we put liquid into barrel and into our warehousing network in Scotland, it now understands the Angel share and the losses and how that changes in different parts of a warehouse individually, from tall to bottom, or in different locations and geographies. So it directs our highest value, highest return inventories to the right locations to minimize the losses. That is happening automatically with decisions and artificial intelligence and learning. There's still humans in the loop. We will get more and more confident for them to start to move out of it, but it's a lot of capital. So we need to make sure that we make really great decisions. And as I said, we'll take that across tequila and North American whiskies and be able to then take and harvest those benefits, which are on shorter time cycles. The second piece is we've clearly been taking some decisions on the assets that we will have, but the utilization of those assets, we've had to accept that some of them will be running at lower utilizations. That is the capital discipline that we need to make sure that we're taking the business, even though some of those decisions are hard. Okay, we're here to protect capital, and sometimes that means that the assets have to be adjusted. Moving forward, you can see in the central chart the shape of the capital that we've had historically. So this is, if you think of net fill, as we empty out of that maturing inventory for bottling, how much are we choosing to then reduce the inventory, or how much are we choosing to put in? You'll see that in F25, we were putting significant incremental in. There's been a big correction in F26, but the sustainable approach, as you see, this is an estimate because bottling changes, and then you've got to stay dynamic with how you distill through the year, and we're doing that much more frequently. We estimate around $700 million will go in over the three-year pilot period into the right areas for returns. We've scaled back production and distillation. That's been done across, in particular, I'd call out Scotch, North American whiskies, and tequila. We're at the minimum requirements for future blend and support of growth. And given the competitive advantage that we have in that, we want to make sure that for great brands like Johnnie Walker, Don Julio, Crown, Bulleit, that we have the liquids available to deliver the quality of liquid and the quantities for future growth. But a very disciplined approach, and we adjust and look at that on a very frequent basis. Tequila monthly, Scotch biannually, and North American whiskies quarterly. Okay, you have to make sure you look at the whole value stream and how we do that, but that's driven, and those decisions are taken at CEO, CFO, and supply level on a regular basis, and now centralized globally. I'll finish on bringing it together under customer service. It is clear, Dave was very honest and transparent, that the business has not been running in an end-to-end fashion with its strategy and its operating model to look at how we deliver best for our customer. We've been focused on that over the last 6 months. We've been able to make some improvements around integrated business planning, simplifying and standardizing KPIs globally, bringing more visibility to the improvement plans and where the challenges are to drive quick improvements. But we've got some more systemic things to be able to fix that will take us a bit longer. So whilst there's some green shoots, it's not good enough, and it has to get a lot better. By doing that, we will improve our working capital, and we'll be able to drive the competitiveness of the business. But I would call out, in particular, forecast bias. As a business globally, we were running at 10%, and it was 10% bias to overset. So essentially, we're putting in place inventory for a much more ambitious plan than the realities. And we're carrying the working capital inefficiencies, whether it be in slow, obsolete, or potentially written off goods, or it be the cost of the warehousing, the efficiency of that warehousing, and the transport networks. We need to get a lot leaner, and we need to deliver the value and the returns from getting a lot leaner. We've made quite a dramatic improvement. It needs to be sustained and needs to be underpinned to make sure that that can be delivered, and in particular through the integrated business planning process and the execution. Alvaro did talk to some of the major improvements that came through in Latin America and the Caribbean. They are further ahead. They've been working on it with a lot of discipline, a lot of sponsorship from Alvaro and the team to make sure as an end-to-end business, everybody is focused on it. They've had the earlier investments when it comes to the advanced supply and demand planning tools They've upweighted their capabilities and the seniority of some of the people taking the decisions, particularly in demand planning, and the discipline to ensure you've got the activations and the building blocks that will deliver from the working capital that gets put in place. But if I look at how they left this fiscal year, they're up at 98% on time, 97% in full. So very strong performance. Their forecast accuracy is one of the best that we've got globally. It's over 70%. And its forecast bias has improved from pretty high double digit to low single digit across Latin America. So the big focus has been, as Alvaro said, Brazil, Colombia, Mexico, but the culture is there across that region, and we need to learn from that and take those learnings very quickly across the rest of Diageo, and that's where we're focused. A couple of grounding in some of the realities in big markets in terms of the improvement we've still got to drive. If you take forecast bias in North America, it was 6%, again, biased to then underselling against it in H1, 7% in Q3. John has gone in, very quickly made sure that the discipline is there in terms of the decision making and ensuring that we can then quickly correct to something that's much more realistic to the demand that's coming through, and therefore the working capital and the returns can sit from a capital deployment against that. In GB, the example is more around execution. The biggest example on that Pareto chart of where the biggest loss on time in full in Q4 was on fulfillment execution. Our order to cash process, our customer operations, and our supply chain execution when it comes to case pick, running of the transport network. There are significant areas of improvement, and that will drive the returns and the working capital improvement as well. So not somewhere to be proud, not somewhere to be satisfied, but very clear on where the improvements can come, and the operating model is again driving the early shift in the business, and now we need to kick on and deliver against that. So, as I started, essentially, every barrel, every drop, every case that gets made to then move around the world has to have discipline, has to have returns on capital, and has to be dynamically reviewed so that it adjusts to what's happening and what's playing out in front of us with the market.